Namaste friends, my name is Kyra Ahuja and welcome once again to our Fund Manager Views show at Emkay Investment Managers. Today we have with us Mr. Kashyap Javeri, Fund Manager at EIML for an insightful views on the markets.
Thank you so much,
Kashyap.
Ahuja.
How are you doing today?
Thank you.
To start with, Kashyap, how do you evaluate the union budget which we presented in the month of July, and what are your key takeaways from this?
So I think what I take home from this budget is that despite not having a full majority in the parliament, this government has shied away from any populism. They have shied away from giving any freebies, as you know they would call it. The budget focuses still on a lot on capex. So if you look at this particular budget, they have kept the overall capital expenditure number same as what was presented in February 2024. Which means that this government is going to spend almost about, or rather this government, including the state governments, they are going to spend almost about 6% of GDP in the capital expenditure. Let me put this in context, right? So our economy is roughly about $3.7 trillion. About 6% of that means we are going to spend upwards of about $200 billion on roads, railways, water, irrigation, affordable housing. There are probably not more than 12-15 countries in this world who have got a total GDP which is more than $200 billion, right? So equivalent of some of these economies, we are going to spend just on some of these avenues of capital expenditure. On, let's say, scale of 1 to 10, I give this budget probably about 8.5. There are some things to be done for a particular section of the society, which we call the bottom of the pyramid. Post-COVID, they have not been able to come up the curve like what all of us have been. They need some support. They have partially provided it, but I'm reasonably sure as we go forward in next few budgets, they are going to take care of that. We have had a fairly great monsoon this year. Crop sowing has been progressing very well, which means the rural part of this economy is going to get really well oiled as we go forward. I think the need for some of the profligacies from the budget's part will be probably mitigated by this. So overall, I think budget, monsoon put together, I think we are set for a great recovery in terms of rural consumption also.
Perfect. Our ENVI strategy has a decent weight in capital goods sector.
Yes.
What is your view on this sector going onwards?
So I think what we saw in the union budget, which is state plus central put together, almost about 6% of GDP being spent on capex. Today, private sector is in no mood to be left out of that whole party, right? If you look at the recent numbers which have been given by the RBI, so they come out with usually in the month of August, the number for project sanctions which are done by the banks for capex. If you look at this particular year, 2023-24, India's private sector and public sector put together, they are going to invest almost about 5.65 lakh crores in total capex. If you look at history in last about, let's say 15 years, this is the highest ever amount that India as a country is going to spend on private capex. The previous peak was in 2010 financial year, where we spent almost about 4,30,000 crores on overall private plus public capex. That number today is surpassing at about 5.65 lakh crores. This capex, and the beauty of it is that if you go back in 2010, almost about 60-70% of that capex used to go to infra. Of that 70% going to infra, almost about 70% used to go to power and related sectors, right? We used to spend oodles of amount of money on fossil fuel power plants. If you look at the number for 2023-24, which is almost about 20% higher than the previous peak, we are going to spend a less amount on power and significantly more amount that we are going to spend on either sectors like metal and metal products. We are going to spend on sectors like chemicals. We are going to spend that money on textiles. We are going to spend that money on roads. We are going to spend that money on housing, right? So some of these long gestation period capex items like power, like a power plant takes almost about 7-8 years to commence the production. Today we are moving into a direction where that capex is fairly diversified and across the sector, and I'm very happy that we have surpassed the previous peak, which a lot of people used to doubt actually. If you would have spoken to a lot of them about 2 years ago, with a lot of them, they would have said that it's virtually not possible because we are not going to put up power plants, which means that we will not cross the previous peak, and we have done that. So I'm very happy, and fortunately, if you look at ENVI, capital goods today is, including let's say cement and others, Today, capital goods will be almost about 16-17% weight,
Right.
and has done phenomenally well for us. I think I will, for next at least about 3 to 5 years, continue to bet on capital goods.
All right. Moving on, there has been a lot of clamor about how banks are finding it difficult to raise deposits because more and more people are wanting to be invested in equities. Do you agree with this view?
So, as much as I would be happy about people investing in equity because that's good for returns as well as business, I partially disagree with that view. Also because that today, like I said, banks have already sanctioned projects worth about 5.5 lakh crores for 23-24. Obviously, when they do those sanctions, they already have a plan in place to fund that capex, right, through the deposits that they raise. Having said that, I think the problem with deposits is that today, people like us, all of us pay taxes, right? In the month of June, most of us would have paid their first installment of advance tax also. Now, if the government does not spend that money, the money does not come back into the system, right? I paid tax, they took it, they put it with RBI, the money has not come back. If you look at the system today, including the tax amounts that we all have paid, including GST, which is lying with the RBI, I think system is pretty much comfortable in terms of liquidity. If you look at, let's say for example, there is 100 rupees of deposits available in the industry at this point of time, almost about 2% of those deposits are lying with RBI in just plain cash, right? Moment they start spending this money, obviously there will be a flow of money into the system. When that money gets into the system, obviously it will roll over and there will be a deposit growth which will come back towards the fag end of this financial year. And I think I'm reasonably sure that if not deposits, banks have plenty of avenues to raise funds for these sanctions that they have done. Obviously they would have done these sanctions keeping something in mind, right, and not just in air. So I'm reasonably confident this capex plans either through bank deposits or let's say bank loans. It could be through ECBs. Today Indian corporates are raising significant amount of money out of this through the foreign bonds also, right? So I think money is going to be there. It's just that we have to execute this capex plans very well to take advantage of that.
And hence, do you think that corporates will find it difficult to fund the capex?
So like I said, you have options of either doing it through bank loans. Today equity markets are so buoyant that the other day you would have heard about that one company which has got 2 Yamaha showrooms, yeah. 12 crore SME IPO, and demand is almost about 4,000 crores. I don't remember the exact number, but I think what I've heard is 4,000 crores, right? So there is a plenty of money available for you to raise through equity sources also. Like I said, the other option is that you can raise the same money through external commercial borrowings. I think there are very confident foreign investors who want to put in money in India. It could be either through equity route or it could be either through the debt route. I think that's also an option available. So I think there are plenty of options available to raise this or to fund this capex. And you have to keep in mind that one of the reasons why we launched ENVI, which is a manufacturing focused fund, was that we saw in 2020-21 that the debt to equity ratio of the whole manufacturing sector was at decadal low, which means you have the pristine balance sheets at this point of time. I think it's not going to be a cakewalk either, but I think it's not going to be a difficult job, either for the corporates.
Sure. Gets me to my next question, Kashyap. Nifty 50 has underperformed the Nifty Pharma and FMCG index in the last 2 years. So how do you visualize these two sectors in your strategy?
So let me put, I think if you look at Nifty Pharma and FMCG, last probably 2.5 years have been, they have been laggards. The whole market except for some of these 2-3 sectors has performed phenomenally well. If I look at FMCG now, I think the monsoon, the fact that crop sowing is progressing very well, the fact that Manrega, people asking jobs under Manrega has fallen to probably a couple of years low. I think rural is coming back in terms of its income levels, which means that it will, reflect in the FMCG growth from the rural point of view. I think it's already reflecting. I mean, if you look at the commentary or if you listen to commentary of most of these FMCG guys, they are already saying that, the rural growth is bouncing back. That's something which is reflected there. For pharma also, again, last 2 years underperformance, but the fact that earnings for pharma companies have grown really well in last 2 years, sector will catch up, it will do really well. But how we are going to play this is that we are not interested in buying companies with probably, still, even after this whole bounce back, 7 to 8% revenue growth, maybe 10-12% earnings growth, but quoting at 60-70p. I think the way we will play it is that if you look at one of the stocks that we have bought recently in our fund, or rather in our strategy, not fund, but in our strategy, is called Hindustan Foods. He is the guy who gets this whole manufacturing outsourced to him from likes of HUL, Dabur, Imami, some of these guys. The FMCG outsourcing industry today is very small in India and it's very fragmented. As that industry consolidates, he will get more and more factories under himself. And when that happens, I think he will show a growth which is faster than the whole of FMCG industry growing at. I think that's the way we want to play it, rather than playing plain FMCG. If you look at Pharma also, the way we have done this is instead of investing in pure generics or pure only domestic focused Pharma, what we have invested is in CRAMS and CDMO. I think that's the strategy that we are going to follow from here on also. But I do believe that FMCG and Pharma, which have underperformed quite a lot in last about 2.5 years, their time probably is coming now.
Sure, interesting. NVPMS just completed 2 years, 2 months ago. And since inception, returns of NV have been 39.6% compared to 31.3% of the benchmark.
Right.
Where do we see NV from here onwards in terms of performance?
So we were fortunate enough to launch ENVI when the whole manufacturing sector started looking up much earlier than when a lot of mushrooming of products started happening, probably last 6 to 9 months, right? Probably every mutual fund with its name is now launching a manufacturing fund. Right. We were fortunate enough to launch it almost about 2 years ago on PMS platform, but we did also a dry run of the same strategy by ourselves for at least about a year prior to that. So it's been on our mind for almost about 3 years now, fortunate enough. Having said that, I think, like I spoke about the capex plan of Indian corporate, right? We have just crossed the previous peak right now. In terms of consumption, if let's say rural consumption bounces back, or rather it has already bounced back, but continues to remain buoyant, I think we are going to consume a lot of housing. We are going to consume a lot of air conditioners. We are going to consume a lot of washing machines. We are going to consume a lot of cars, bikes. You speak of a discretionary consumption and we are going to be there. Today, there is no boardroom discussion which happens across the globe. I mean, if you take any corporate worth its name, whether it is large electricity related equipment producers like Siemens, whether it is one of the largest producer of aeroplanes in the world, Boeing, whether you look at the largest manufacturer of 3G, 4G, 5G equipment manufacturer like Ericsson, they cannot avoid India now anymore in their boardroom discussions. It has to be there, which means going forward, we are going to continue to see a lot of investments happening in the manufacturing space. I think my strategy ENVI is going to have its life probably for next 5, 10, 20 years. I would not be probably shying away even from, probably saying that it might last beyond even 20 years. Manufacturing in China has lasted for 30 years and it's still going on. Right. We haven't still scratched the surface. So you have to have the right sector, the right stocks. I would say right stocks rather than sector. And if you're there early, I think ENVI is the place to go.
Perfect. Kashyap, currently automobile has had the largest share in your portfolio.
Right.
Which segments do you foresee leading growth in the sector in the near future?
So I think automobile will continue to do well, though today there is a bit of a lull there because we are coming off quite a high base of last year. But within let's say the vehicle market, two-wheelers continue to do very well. Four-wheelers are today some bit moderate, or there's a bit of a lull. As we go forward, like I said, if you are going to continue to grow your per capita GDP in a high single-digit number, there is no way that on a secular trend basis, some of these items will not be consumed by India. So my bets will be discretionary spends. It would be automobile. It could be also auto. In fact, if you look at our portfolio, there is more weight on auto ancillary than actually automobile, right? So we are going to continue to see a lot of investments happening in auto ancillary, not because it's going to be consumed only in India, but if you look at most of the Indian auto ancillary companies today are actually manufacturing for the world. Today, the supply chains in auto ancillary is actually shifting from Europe, which used to be one of the torchbearer or the leader in auto ancillary space. It's now even moving from China. It's moving from Latin American countries like Mexico. It's moving actually to India. And I think I continue to find a fair bit of confidence in our corporates that globally, if there is one space besides chemicals or besides textiles where India can have its its fame is actually auto ancillary. I think I will continue to bet there, more probably on auto ancillary going forward than maybe automobiles companies themselves. But I think all discretionary space, whether it is auto ancillary, it's consumer goods, it's something related to housing, though we don't invest in real estate, but something related to housing, it could be building materials.
Right.
I think we are going to continue to invest there.
Perfect. Gets me to my last question, but can you name a few stocks which have done well for you in the last 2 years?
So now that we have made decent amount of money, obviously, no harms in disclosing some of these names, and we have made money across the market caps, right? So if you look at last about 3 years, they have been attributed largely to small and mid cap investing.
Right.
But ENVI as a strategy has also invested in large and mid cap space quite a bit. So if you look at large cap space, we have made phenomenal returns in Ultratech Cement. We have made really amazing money in L&T, Larsen and Toubro. Again, our call on capital goods. Right. We have in mid cap space, we have made a good deal of money in Supreme Industries, building material space. We have made great deal of money in endurance technologies, auto ancillary space. If you look at small cap, it's across the board. I mean, we have about 50-55% weight there, and almost every stock worth its name has done really well. But to name a few where we have made a multi-bagger, so Elecon Engineering is one. We have made great money in one of the stock which is related to both defense as well as EMS, which is Centum Electronics. One of the great contributor to our portfolio has been Kirloskar Pneumatic, again capital goods. So most of the sectors that I spoke about, these all stocks belong to probably the same name, same sectors, right? So these are where we have made great deal of money.
Perfect. Great, Kashyap. And now moving on to my favorite part of the show, which is the rapid fire round. I will give you 10 seconds. Your views will be either bullish, bearish or neutral.
Perfect.
Ready, Kashyap?
Yep.
Specialty chemicals.
Bullish.
Capital goods.
Super bullish.
Auto and auto ancillaries.
Bullish.
Cement.
Neutral.
Retail and consumer goods.
Bullish.
Real estate.
Neutral.
Infrastructure.
Bullish.
Technology sector.
Neutral to bearish.
And BFSI.
Bullish.
Which is not a part of your portfolio.
It's not part of our portfolio, but let me make it very clear. We are a growing economy. People, not only corporate, but people like you and me who have aspirations in life, we will need a lot of money to expand our own, whether it is real estate portfolio, whether it is equity portfolio, whether it is any kind of assets. We all are going to need money. Maybe magnitudes will differ, but we all are going to need that money, including corporates who are going to raise money for their own capex. So there is no way that there is not going to be action in BFSI also. They have been underperforming for almost about 2 years now. But I think going forward, if we as an economy want to expand, BFSI we will need a lot more than what we can imagine, and which is why I think sector will do well.
Great. Thank you, Kashyap, for your views, and congratulations on such a great performance of ENVI since inception and the last 2 years. That brings us to an end for today's show, and thank you once again.
Thank you so much, Kyra. Thank you.